Greeting students, let us resume with Account Standard 10, Property, Plant and Equipment, PP. In my last video, I explained when to recognize PP. Today we will begin discussing at what value, I repeat, at what value PP should be recognized. As I already mentioned, this is a vast chapter. You will require multiple videos to cover it thoroughly. Let us get started. Recognition of initial cost. Initial cost consists of purchase price, directly attributable cost, cost of dismantling, and restoration obligation. Now, purchase price, cash versus credit. Only cash price should be considered for recognition. When an asset is purchased, the initial cost recognized as part of PP includes cash price equivalent of the asset. That means if the asset is brought from deferred credit names or payment is delayed over time, only the present value, that is cash price. I repeat, only the present value, that is cash price, is capitalized. Deferred payment interest should be excluded from the cost of the asset. For example, a machine is purchased for rupees 10 lakhs with deferred payment over 3 years. And let us assume the cash price of the machine is rupees 8.5 lakhs. Obviously, the remaining 1.5 lakhs represents interest over the deferred payment period. Now, accounting treatment. Rupees 8.5 lakhs capitalized as part of PP, whereas rupees 1.5 lakhs treated as interest expense, not capitalized. Okay. Now, interest component. Just link it to account standard 16, borrowing costs. Well, A16, borrowing costs, comes into play only when borrowing costs are directly attributable to the acquisition, construction, or production of a qualifying asset. Example, a factory under construction. That's a qualifying asset. ഇനി എന്താണ് ഈ ക്വാളിഫയിങ് അസറ്റ് എന്നെല്ലാം നമുക്ക് വിശദീകരിച്ച് അക്കൗണ്ട് സ്റ്റാൻഡേർഡ് 16 ബോറോയിങ് കോഴ്സ് പഠിക്കുമ്പോൾ മനസ്സിലാവും. ഓക്കെ. Well, in such cases, അതായത് qualifying asset ആണെങ്കിൽ interest may be capitalized as part of the cost. I repeat, as part of the cost until the asset is ready for its intended use. But if the purchase is a simple deferred credit purchase, not involving qualifying asset or construction, then the interest is not capitalized either under accounting standard 10 or accounting standard 16. മനസ്സിലായില്ലേ? Tax. Now, as far as tax as a part of purchase cost is concerned, you can include it provided that you do not take any input credit. The input credit, GST, എല്ലാം ഒരു ഫെയർ ഐഡിയ ഉണ്ടെന്ന് ഞാൻ കരുതുന്നു. ഏതായാലും ഇത്രയും കരുതുക. ഇൻപുട്ട് ക്രെഡിറ്റ് എടുക്കുകയാണെങ്കിൽ കോസ്റ്റിൽ കിഴിവുണ്ടാവില്ല. ഇൻപുട്ട് ക്രെഡിറ്റ് എടുക്കുന്നില്ലെങ്കിൽ അത് നമുക്ക് ടാക്സ് കോസ്റ്റിനോട് ആഡ് ചെയ്യാൻ പറ്റും. ഓക്കെ. ഡയറക്ട്ലി അട്രിബ്യൂട്ടബിൾ കോസ്റ്റ് ആസ് പെർ അക്കൗണ്ടിംഗ് സ്റ്റാൻഡേർഡ്. What is it? It is nothing but cost incurred till the time asset is ready to be put to use, such as site preparation costs, costs for clearing, leveling, or demolishing existing structures, initial delivery or handling costs, freight, transportation, and insurance on delivery, installation and assembly costs, charges for erecting or installing the machinery or asset, costs of testing whether the asset is functioning properly, net cost of trial runs, that is cost minus any revenue generated. അതായത് ഒരു ട്രയൽ റൺ നടത്തിയിട്ട് 1,00,000 രൂപ ചെലവഴിച്ചു, പക്ഷെ ഒരു ഇൻസിഡന്റിൽ ഒരു 5,000 രൂപ നമുക്കൊരു റവന്യൂ അതിൽ നിന്ന് കിട്ടിയെന്ന് വിചാരിക്കും. 95,000 കണക്ക്. ഓക്കെ. നെക്സ്റ്റ്, professional fees such as architect's fees, engineer's fees, legal fees, or consultancy fees directly related to construction or acquisition. Next, cost of major inspection, that's otherwise called replacements, when necessary to bring the item to working condition and if recognized as part of the cost. മനസ്സിലായോ? അതായത് ഒരു റീപ്ലേസ്മെന്റ് കോസ്റ്റ് അല്ലെങ്കിൽ മേജർ ഇൻസ്പെക്ഷൻ കോസ്റ്റ് അത് വർക്കിംഗ് കണ്ടീഷനിലാക്കണം അസറ്റ്, അതിന് വേണ്ടിയിട്ടുള്ളതാണെങ്കിൽ കൺസിഡർ ചെയ്യും. import duties and non-refundable taxes. That is only if not recoverable from tax authorities. ടാക്സ് കൊടുത്തു പക്ഷെ അത് റിക്കവറബിൾ ആണെങ്കിൽ അത് കൺസിഡർ ചെയ്യില്ല. അതേസമയം ടാക്സ് കൊടുത്തു പെർമനന്റ് എക്സ്പെൻസ് മീൻസ് ഇറ്റ് വിൽ ബി കൺസിഡേർഡ്. ഓക്കെ. Cost of dismantling and restoration obligation. Well, when an item of property, plant, and equipment is acquired, A10 requires initial recognition at cost. And as you have seen by now, this will include several components. One such component often ignored by students, but very important, is the cost of dismantling, removal, and site restoration obligation. Now, what's it? This is a future obligation to restore the site or dismantle the asset at the end of its useful life. For example, a company installs an oil rig or a telecom tower. The company may be legally or contractually required to remove the asset and restore the site. Even if the payment happened a year later, that is future obligation. The present value of the cost, I repeat, the present value of the cost is included in the cost of PP on day one. Now, why it is included in the purchase cost? Because A10 says all directly attributable costs. I repeat, all directly attributable costs necessary to bring the asset to its present location and condition must be capitalized. This obligation arises due to the installation of the asset, is it not? So it is attributable to the assets, that's all. However, there are certain exclusions to the directly attributable costs. Let us learn one by one. New location costs. When a business opens or relocates to a new location, it may incur several costs, such as moving plant or equipment, retraining staff at the new location, setting up operations in the new region, example permits, logistics, registration, etc. However, as per ASPEN, such costs are not considered as part of the cost of the PP. Why? Reason is that the costs are not directly attributable to bringing the specific asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. Therefore, expenses incurred to shift the end plant, even if it includes some PP, to a new city or state, are treated as period cost or relocation expenses. I repeat, it will be treated as period cost or relocation expenses and are not capitalized. These costs are charged to the P&L account in the period they are incurred. We can conclude that if a cost doesn't help get the specific asset ready for use, I said ready for use, in the way the business intends, it doesn't go to the cost of PPE. Okay. Next one, new product. We know that account standard 10 PPE deals with tangible assets used in the business operations. However, when a company incurs cost to it introducing a new product, there is often a confusion. Can this cost be added to the cost of PPE? The answer is no. Costs related to new product development are not capitalized as part of PP under AS10. Now, what do you mean by cost towards a new product? These are expenses incurred to design or develop a new product or service, conduct market research or feasibility studies, do test marketing, run trial production. Of course, not for checking machinery, but for developing a product, and develop or set up a new line of business. Now, why these costs are not part of PP cost? Well, AS10 allows capitalization only of costs that are directly attributable to bringing the asset to the location and condition necessary for it to operate as intended, are not general in nature or future focused. I repeat, are not general in nature or future focused. Briefly, New product development is not about making the asset, for example, a machinery, ready to work. I repeat briefly, new product development is not about making the asset, for example, a machine, ready to work, but about how you plan to use that machine later. That's a business decision, not a technical readiness cost. You conclude, let's have a golden rule. If the cost is about making the asset ready, yes, including PPE. If the cost is about what you plan to produce, no, not to include in PPE. I repeat the golden rule. If the cost is about making the asset ready, yes, include in PPE. If the cost is about what you plan to produce, no, not to include in PPE. Next one, new service. For example, cost in hiring training staff to deliver a new IT service or setting up a new help desk are operational in nature and not PP related. Next, new facility inauguration. Expenditure on inaugurating or launching a facility, such as opening ceremonies, decorations, hospitality, publicity. These are not necessary to bring an asset to usable condition. Example of such expenditures are costs of ribbon cutting, advertisements, or public events for a new factory. These are excluded from PP costs. മറക്കരുത് ഇപ്പോൾ നമ്മൾ എന്താണ് ഡിസ്കസ് ചെയ്തുകൊണ്ടിരിക്കുന്നത് എക്സ്ക്ലൂഷൻസ് ഫ്രം ഡയറക്ട്ലി അട്രിബ്യൂട്ടബിൾ കോസ്റ്റ് നെക്സ്റ്റ് വൺ അഡ്മിനിസ്ട്രേറ്റീവ് ഓവർഹെഡ്സ് general admin expenses like salaries of finance staff, stationery expenses, HR costs, etc. do not directly relate to construction or acquisition of PP and are not capitalized. Okay. However, please note that if admin expenses are specifically and directly attributable to bringing the asset to working condition, they must be included. Otherwise, they are expenses. Selling and distribution overheads. Costs relating to selling products are clearly unrelated to the acquisition or construction of PP and are therefore excluded. These include marketing expenses, advertising costs, sales teams travel and accommodation, promotional material, freight or distribution to customers, etc. These are costs related to revenue generation and not asset acquisition or readiness. Well, practical questions from these particular topics are often asked in the ICAI board exam. Hence, a little more about this topic. Suppose company sets up a warehouse and incurs the following costs. One, construction of warehouse, including PPE, very much. Purchase and installation of storage, shelves, same, included in PPE. Warehouse staff training to operate special equipment, that too included. Whereas the following are excluded. Marketing teams travel to promote distribution capability. Advertising campaign to launch faster service. In other words, only costs directly related to making the warehouse ready for use are capitalized. Costs related to promoting, selling, or distribution strategy are expense to profit and loss. So now it's clear. Yes, directly distributable means directly contributing to the physical assets readiness for use and not to the business ability to sell or distribute goods. I repeat, directly contributable means directly contributing to the physical assets readiness for use and not to the business ability to sell or distribute goods. If the cost is about making it work, include it. Which is about making it sell, expense it. That's all. And the last one, internal profit. This happens when an asset is self-constructed. Okay? When a company constructs an asset internally, say building its own office, the transfer pricing or notional profits. I repeat, the transfer pricing or notional profits made by internal departments involved in this self-construction should not be included in cost of the asset. Well, students, I have been covering Accounting Standard 10, Property, Plant and Equipment, in parts through these videos. In this session, we focus only on the initial recognition. Well, items 7 to 17 from this list will be covered in the upcoming videos. Stay consistent with your studies, and I will see you in the next session. Take care of yourself. Bye for now.